Welcome to the AACFB's 2026 Meet the Funder webinar series. My name is Monica Harper. I'm the Executive Director of the AACFB, and I'll be your host. Our presenter today is Mike Suzuki from Maynards Equipment Finance. Maynards Equipment Finance is both a Funding Source member and a gold sponsor of the AACFB, and I'd like to thank them for their support of the association. Before I introduce Mike, I want to go over a few items to make this webinar more enjoyable and informative for everyone. During the presentation, you should see a Q&A box that allows you to ask questions. If you have any questions during the presentation, please submit your questions in the box and they will be answered by the end of the webinar. Please reserve the chat for communication between attendees. The entire webinar should take no more than 30 to 45 minutes. And for those of you who would like to review this at a later date, it will be posted on the 2026 Meet the Funder page of the website, and it will be emailed out to the AACFB membership. At this time, I will turn it over to Mike. It is all yours.
Thank you very much, Monica. And welcome to everyone. This is our first time conducting one of these Meet the Funder webinars, and we're really excited to share a little bit about our story. As Monica had shared, I am the president of our equipment finance line of business and also a partner in our Maynards group of companies. So again, thank you for making the time to connect, and I look forward to our conversation. In today's presentation, I only have a few short 10 slides, including our title one. And it's at this time I'd like to introduce our Maynards group, because I really feel like that helps tell the story on how we evolved into our equipment finance line of business. And so at Maynards, we have been around since 1902. And as you can imagine, like other companies, we have evolved, as has our story. But if I was to boil it down to just one key thing, it would be a humble but confident understanding of what used machinery and equipment is worth. And we take that core competency and add on a layer of marketing and understanding marketplaces so that we can ultimately help our customers monetize their assets. And so we do that at Maynards through three key lines of business. I'm going to touch on both our auction business and our appraisal business very briefly, and that will naturally lead into our equipment finance business. So let's get started here. Okay, our auction business. This is our largest line of business and probably our oldest one. We hold approximately 150 to 175 auctions a year. 2/3 of those are in North America, with the remaining coming primarily out of our offices in Europe, where we have been growing. We have offices in the UK, Germany, Hungary, Czech, and we also have offices in New Delhi in India and also Shanghai in China. And these offices in Europe and Asia work together just to really help our customers both procure assets and also find new markets to sell them. And as you can imagine, with the large market being in North America, most of our business is done in the United States, although we do have offices in Canada and Mexico. So the key thing that I would share here is that we definitely have a global reach and a good pulse on what the larger economy is doing and what industries within countries are doing, and by extension, how that drives and impacts the value of these various companies' assets. And I say various companies because we will deal with customers that are Fortune 500 through to a smaller ma and pa machine shop. And we also cover an equally wide range of industry type. And so I would consider ourselves generalists, but experts in terms of being able to help pinpoint what the value is of companies' machinery and equipment. Okay, that leads me to our second line of business, and that's our appraisal business. I highlight the fact that all of our appraisals are USPAP compliant. We take a lot of pride in that. There are standards that we have to meet with each appraisal report that we send out, and we ensure that the quality of our reports are meeting the industry's highest standards because our appraisers also carry the industry's highest designations. Our primary focus is on appraising machinery and equipment, but we absolutely help our customers that carry inventories, and we provide appraisal reports for them also. As you can see from the few stats that I've included on the left-hand side, we produce over 200 reports a year. We have an ever-growing database of not only appraisal results, but auction results to ensure that we're following trends and staying on top of what is impacting machinery and equipment values. And we have a very diverse customer base, fortunately. We're grateful for the relationships that we've created with some of the largest financial institutions in the world through to small private lenders. So that's our appraisal business. and we have a very strong presence in North America. So that leads me finally to our equipment finance line of business. My partners and I were thinking about how can we grow on this core competency of having an established auction and appraisal business. And we kind of asked ourselves, what if? What if we decided to lend money and use the equipment that we're familiar and values with as the collateral? And so we decided to start that business with kind of a simple approach. We're going to underwrite our loans based on the value of the collateral and not the credit. And so with that in mind, that enables us to probably play a little bit of a niche role in the equipment finance world. And it also allows us to solve for some of the customer's issues or goals that might include some things that I've listed here. Refinance used equipment, maybe just a cash out. Sometimes customers are under pressure from various other lenders, or maybe they just want to simplify their balance sheet and consolidate debt. Other customers that we help are in high growth mode, sometimes even pre-revenue. And so they're looking to acquire other assets or maybe even acquire an entire company, and we can help them do that. Other companies are saying, hey, I've got a bunch of equity in my equipment, but I need it in my checking account right now for various reasons. And so we can help customers do that, underwrite their machinery and equipment as collateral and inject working capital directly into their business. And then, of course, there's also situations where companies might not be bankable in more traditional sense because they've experienced losses for various reasons. And so we look past that because, again, we're underwriting the equipment, not the collateral. And so those are just a few reasons as to what we've found we can help customers with our equipment finance offering. Next, getting into a couple more details here. Again, kind of doubling down on the fact that we're collateral-based lenders, not credit-based lenders. And so with that being said, our financial insight into our customers, and I don't mean this in a flippant way, but it's literally whether or not a monthly payment clears the account or not. We're not underwriting credit. We're not pulling credit. We're not asking for financial statements, and calculating monthly or quarterly or annual ratios to determine if a company is within covenant. We don't have financial covenants. What we do is we go out and we appraise the assets at the forced liquidation value methodology, which in some ways is very much similar to the auction value of the equipment. And then we determine based on customer profile, perhaps getting to meet them, understanding their maintenance programs, we will then make an offer of a loan amount that's something less than the appraised value. That right there is 90% of our underwriting. Okay, so how do we get there? I would say there's 3 key steps. And as you can see here, sometimes we can fund a loan in less than 2 weeks, and sometimes it might take closer to a month. Just depends on each situation. But these are the 3 key steps. First, we ask for an equipment listing. Make, model, year, hours or miles if that's applicable, and ideally some photos. We'd also like to know where we would be inspecting those assets. And if possible, and if it's applicable, if there's any debt on these pieces of equipment. We certainly don't mind consolidating paying off other lenders. We just want to make sure we're understanding how much that's going to be. After we get that listing in, we then use our internal resources and we call upon primarily our appraisal team to say, hey, listen, here's a listing. Before we go out and inspect it, before we ask money for an appraisal, can you give me a range on what we think the value might come in at? Give me some goalposts. And the reason we ask for that is because we want to know before we get going, before we invest any more of your time or your client's time or your client's money, that we think there's a deal there. And if we do, we put together a few-page proposal with the intention to be as clear and transparent as possible and say, we think the appraisal can come in at this range. By extension, we believe a loan amount could come in at this range. And we think then therefore we don't think, we then provide the remaining terms and conditions of that loan. And we lay all of that out there. So through steps 1 and 2, what we need from yourselves and your customers is that equipment listing. We'll then invest our time and energy on determining whether or not we can put forward a competitive proposal. And if everyone likes the terms of those, Then basically we just follow through on our due diligence. We get the final appraisal done, which firms up the final loan amount. We need to make sure we're in first position on the collateral. We do that through lien searches, a couple loan documents, and if necessary, depending on the asset type, we would be registering our title either, excuse me, we would be registering our lien either directly on a vehicle's title or by filing a UCC1. Sometimes other lenders want to stay in play, and that could be fine. We work that out, make sure that Maynards has a first lien on the particular collateral that's being used for this loan, and we carve out the rest. We're not looking to over-securitize ourselves, but we are looking to be in first position. So those are the 3 steps. Equipment listing, Maynards does some homework, makes a proposal, and then we finish the deal off by completing a funding. Okay, get just a couple more slides here, but this gets us into kind of a little bit more of the nitty-gritty or the terms and conditions. Again, as I'd mentioned, we typically will lend up to 80% of the forced liquidation value. Terms and amortizations can certainly range depending on the customer need, the condition of the equipment, sometimes the industry they're in, also getting to understand the ownership and management. What type of maintenance programs do they have? We do that really through face-to-face interview more than anything. But in general, we can offer terms as low as 12 months and maybe as long as 48. And our amortizations can go up to 60 months. Sometimes we'll tack on 3 months of interest-only payments before we get into the normal payment schedule. But this 70 to 80% forced liquidation value, 12 to 48 month term, and 60-month amortizations is going to cover off probably 90% of our proposals. In terms of interest rates, we float our interest rate. It's a straight loan. It's a term loan. We're not looking to own anyone's equipment. We're simply looking to have a first lien on it. And we do that via a term loan versus any other type of financial vehicle. And so we float our interest rates based on prime. Prime has been at 6.75% since December of last year. And depending on our loan to value and some other factors, we probably will add between 7 to 12% to the customer facing interest rate. In terms of referral fees, we will work with you and take a lot of your guidance in terms of basically how many points, if you will, that you would like to earn on the loan amount. We deduct that from the loan amount at closing with net proceeds going to the customer. And we show an exhibit in our proposal so that that's kind of clear and transparent for everyone. In terms of the security, I've included a few things that we require there, which I've touched on. Often it'll include a personal guarantee. We're typically dealing with kind of smaller or medium-sized businesses. But when we get involved with firms that are owned by PE or other situations, we can sometimes eliminate the guarantee and we mitigate that through other ways. As I mentioned, there are no financial ratio covenants in any of our proposals, and our appraisals are conducted by our Maynards appraisal team using the forced liquidation value methodology. Here are just a few tombstones. If anyone came by our booth at the last conference, you might have seen these. We had a few of these on display. Obviously, it's not intended to be an eye chart. It's just to simply show and kind of offer a speaking point that the types of customer profiles that are working with us would be literally startups, pre-revenue startups. Owners have purchased equipment. They now want to draw some of that equity out of it so that they can get the working capital they need to get up and running. I've got an example here of a charter bus business. As we all know, the World Cup's going on, and we had a lot of requests for charter buses, both refinancing and also to help companies acquire more buses as they meet the seasonal demand. In the case of this $1.2 million deal, we basically appraised the entire fleet of the charter bus company, gave them money that helped them both with their working capital, but also more specifically to buy more buses to grow their business. The example in the middle is acquisition financing. Basically, we had a company say, I want to go buy company A. Can you please go do an appraisal on company A's machinery and equipment and let me know how much you'd lend? In round numbers, the buyer put $1 million down. We then contributed $1 million towards the source of funds, and the seller took $1 million note back. And so that we helped the customer buy another company. In the farming deal there, $500,000 refinance. I think for anyone that works with farmers or in other seasonal businesses, cash flow doesn't go kind of in a straight line. Sometimes there's some lumps and bumps in there, and that's just normal. And so what we did there was we helped give the customer almost a line of credit where we could assist them during the low cash flow periods of time, and then they would be able to repay in some kind of more seasonal payments. I'm not going to imply, and I want to be clear, we didn't have a bunch of interest only leading up to one big payment, but we are able to work with the customer to kind of match payments to the season. And in the final example there on the right, a customer had already bought a business. They were operating great, but then they signed a new contract and they basically got some additional fast food restaurants to join in their food distribution. And they needed to basically freshen up their fleet. And so we gave them a small $400,000 term loan. Okay, we're down to the most important slide for many. How do we pay referral fees? As I mentioned, we pay as a percentage of the loan amount. From what we're looking for, again, kind of coming in is that equipment listing. And once you're comfortable, an introduction to the customer, that can happen early, that can happen late. Depends on how much you want to work on the file and how much you'd like to work with us. We welcome your presence, of course, throughout the entire transaction. And over time, we've found that people we've worked with time and time again know the process. We basically are getting an equipment listing, and then we let them know when we're funding. So not taking up too much of their time. I only mention that because we try to keep things straightforward and simple in terms of how we pay these referral fees. So again, we pay them as a percentage of the loan amount, and we pay them at closing. So in the case of, let's just use the top line there, we're doing a $500,000 loan to the customer, and you have got yourself either 2 or 3% of that loan amount. So we're going to wire you $10,000 or $15,000 at closing, and it will be part of the closing statement. I provided a couple other examples, but obviously that's very straightforward. I've also kind of capped our loan amount example here at 5 million. I will share in the last 24 months, the largest deal we've funded is about 28 million, and the smallest deal that we've funded is 350,000. We haven't lost a deal based on size, but we've also found, just in being transparent, that once you start to get too much above $10 million, there seems to be other options that are a little less expensive that those types of companies can seek when looking to refinance and leverage their equipment as collateral. Okay, that leads me to my final slide. Just sharing kind of some frequently asked questions or ones that we get at the booth when we're at the AACFB conferences. And I'll just take a minute to quickly answer them and then turn it back to Monica. But we do get answered, do you hold your own loans? And the answer is yes. Yes, we do. We keep everything on our own balance sheet with one exception. There are a couple other businesses in our same space. I consider them both partners and competitors at times. And I say partners because on certain size deals or certain types of equipment, companies like us might choose to share the risk. And so if there is a $10 million deal, and maybe we only want to hold 5, or maybe we only want to hold 2, and a couple other people might participate in that. But we are a funder, and we do hold these loans on our balance sheet. Why forced liquidation value? Why not a different valuation? We do get criticized at times that forced liquidation value is too low. I will say this. The first thing that I'd like to do is to acknowledge to all of our customers that their equipment absolutely is worth more than forced liquidation value, as they very much know. They're using the equipment to generate revenue every day. The reason why we use forced liquidation value, which is basically one of the lowest valuations when issuing an appraisal report that's USPAP compliant, is that because that's the what if value. What if we end up needing to sell the equipment? We would do that via an auction. And so that's our underlying kind of value. How often do you auction the equipment? You've got an auction company, you've got an appraisal company, you've started the finance company. I think it's a very fair question, and truthfully one that we're a little sensitive to. It's one of the reasons that we offer term loans and not a different type of financing structure. We want to start a relationship right out of the gate with we do not want to sell your equipment and we don't want to own your equipment. We just are comfortable you pledging your equipment as collateral to secure our loan. However, there are times, and touch wood, but fortunately, it's been less than 5% of the time in our portfolio that ultimately the customer, for whatever reason, has not been able to make their payments. We've always had the customer work with us in tandem. It's our mutual goal to maximize the value of the equipment. And so I would say to answer that third question there, how often do you auction the equipment? Currently, that's less than 5% of the time. And then how do we overcome upfront costs? I talked about the need for an appraisal, that being one, and there's some other due diligence costs that we can get into. But in terms of how do we overcome them, we've tried to break them down into smaller pieces. And so and I'll just use a $10,000 example, while due diligence could be 10 or 20 or $30,000, we're not going to ask for that full amount up front. We're going to say this would be the cost of the appraisal. Let's get that across the finish line. That'll firm up our loan amount. Okay, great. We've got the loan amount done. Now we got to make sure we get our lien searches done. We want to get any legal work that needs to be done and our documents prepared. Maybe we need to work with a landlord, whatever it is, send in that payment. And then if there's anything remaining, often we can just deduct that from loan proceeds as we close. The point of it is that we want to work with our customers. We don't want to have surprises, but we do need some of their commitment up front. And so that's how we've been able to, at least at times, overcome some of these upfront costs is by breaking them down into smaller payments versus asking a customer for a larger check up front without really giving the customer much certainty that we could close. And so there you have it, Monica. I've done my best to get through those 10 slides that I promised, and I'll turn it back to you. Thank
Sure,
you.
you did a great job. I will give everybody a minute to put your questions in the Q&A box. We do have a few to get us started, but if you have questions, please put them in the Q&A box now. First question is, do you finance aircraft? And if so, what types of aircraft or value limitation is there, whichever is easiest to describe briefly?
Sure. We currently do not have any aircraft in our portfolio. However, we do have another option available to people that are looking to do that. And if that question wouldn't mind emailing me directly, I could make that introduction to our fund that has an aircraft specialist within it.
And this is
Possibly
a
can help.
follow-up to that one is
Yeah.
what LTV do you loan on aircraft and which value, retail,
Yes.
wholesale, liquidation?
Shoot. I'm sorry I don't have the answer to the aircraft. We haven't done any of those currently. But I do know a very, very confident source that might be able to help.
Great.
Sorry about that. Thanks.
How do you determine your due diligence fees? Do you really conduct an in-person meeting or is that over the internet?
Yeah, sure. Great question. So part of our proposals include what we refer to as Exhibit C. And Exhibit C is a detailed written budget of both the appraisal cost, any out-of-pocket costs associated with the appraisal. We list those out. Then we have a line-by-line budget for our due diligence. That would include lien searches, legal, possibly titling, registration of UCC, sometimes GPS if that's applicable. We lay all that out on a case-by-case basis. And so, unfortunately, I couldn't give a standard answer only because, for example, if we're appraising a smaller shop and the appraisal is only $5,000, that could be one thing. But at the same time, we could be looking at a deal where the appraisal is 50,000. And so those costs really range on a case by case. But once we get the equipment listing and the location or locations where we can inspect the assets, we will lay out a detailed budget on what those costs are.
Okay. This is a multi-question question. The first one is, do you lend in every state?
Yes.
Okay.
And Canada.
Do we need to be licensed in California and New York?
In terms of referring us a deal?
I guess I'm guessing,
no.
does the broker need to be licensed or?
No.
Okay. Do you do over-the-road trucking?
Yes, many. Most recently, we appraised 748 truck and trailer in the Northwest. The company was purchasing three of the five companies that were going through a bankruptcy process, and they were looking to leverage their acquisition. We sent out four appraisers to four different states, mostly did the inspections at nighttime when the units were coming back to the yard and over the weekend, provided the appraisal report and completed the funding. We also work with smaller operations. Same approach
Um,
though.
Great. Next one, new or used equipment or both?
Yeah, I would say we're only competitive in used. And the reason why is because I think there are so many great lenders out there that have great relationships that understand the value and depreciation of new equipment, and they're ready to roll and do it quickly. Our underwriting is really based on what is the forced liquidation value of that piece of equipment. And so anytime we have worked with new equipment, there's obviously a big haircut that's taken off the top, and then we're only willing to lend a portion of that auction value. So we just typically we don't fund enough to be competitive. Um, with that being said, there certainly are examples in the portfolio where, for whatever reason, the customers just felt more comfortable going down that path, and we've helped them.
Okay. What is the requirement for a startup?
Equipment listing, make, model, year, hours or miles, some pictures. We do require the equipment to be operational. So once it's operational, we're good.
Okay. Do you have a minimum loan amount?
Yeah, we do. 350,000 is the minimum funding. We were at 250, Monica, when we first got introduced to AACFB, which I have fond memories of being in Vegas at my very first conference. I loved it. And then we've just found over time with a couple of due diligence costs and things like that, and our business growing also, that kind of 350 is the new minimum.
Okay. How much would the upfront cost run on a $50,000 lease, and what is your minimum lease amount? So same question for that.
Yeah. Unfortunately, our minimum funding is $350,000.
Yeah.
And so the appraisals are really driven off of how many pieces of equipment are we looking at and where are they located. And we can
Um,
quote that typically just for clarity. We do our best once that equipment listing comes in. I mean, if it's a good listing, typically we can get return information back to people inside of 48 hours and often before.
okay, great. Will you do annual payments for ag-related customers?
We're not there yet, but I will say this, for people that have an interest in ag and some expertise in ag, I'd be very open and would request time to learn more about how we can structure our loans that match the seasonality of a customer's cash flow. With all that being said, I tried to give one example of the farming. We're not perfect at it. It's a little bumpy. We'd like to get better at it, but I don't think we're close to doing one payment a year yet. I wouldn't think that, to specifically answer the question. Yeah.
Okay, that's great. Looks like that's all the questions. I'll give it just a second. See if
Okay.
anybody else is still
Sure.
typing.
I should probably leave my contact information up here.
Absolutely, yeah. If they come up with anything later, they can
Okay.
always get in contact with you. But
Great.
yeah, it looks like that's all the questions, but great participation. So with that, I want to say a big thank you to all the participants, and especially our valued Funding Source member and gold sponsor, Maynards Equipment and Finance. Thanks for a great job, Mike.
Thank
We
you.
invite everyone to meet with Maynard's Equipment Finance and Mike at the AACFB Commercial Financing Expo coming up this October in Irvine, California. Thanks and have a great day.
Alrighty. Thanks, everyone.